big market debate powered by Investonomics, an initiative by ICICI Direct. I am Geeta Moza, and joining me today is Mr. Brijesh Singh, Senior Technical Analyst, Opulent Investment Advisors, and Mr. Sameer Dalal, CEO, Natverlal and Sons Stock Brokers. Welcome, Sameer, and welcome, Brijesh.
Thank you.
Thank you.
Sameer, my first question to you. Markets are at record highs. Nifty beyond 16,000 levels now. Sensex beyond 54,000 levels now. What is expected at these levels? Will you be a buyer at these levels?
So it's all relative, right? Certain stocks may look good and attractive from a longer term point of view. Certain may have valuations which have probably moved beyond reasonable levels. So you got to take everything individually. If you ask me, you can't look at the broader indices and only say whether you should buy or sell. There are components within that as well. So you have to focus on those components. However, having said that, have valuations reached significantly higher level for the indices? Yes, they have. We are probably trading 1 to 1.5 times the normal averages of the standard or above standard deviation of the normal averages, right? And historically, if you go and look, markets usually go to these kind of levels, maybe closer towards 2, and then they start turning down. Because you can get over optimism on the bullish side as well, which pulls your valuation multiples up, and then you get pessimistic kind of valuations, which pull your valuations down. But you'll never get it moving at the straight line. So honestly, I believe that we are at the higher side. The risk reward is not in favor of going out and buying the broader indices. Okay. Maybe the bank Nifty is still something you can look at because banking has not rallied similar to the Nifty. But I feel that you need to have a little bit of caution and keep stop losses, even if you're planning on going long, because we are in a raging bull market. Keep your stop losses, strict stop losses, and work with that.
Brijesh, what do charts say? I mean, Nifty beyond 16,000 levels. We have all been waiting for 16,000, and now it's touched a high of 16,349. What next?
So, Geeta, if you look out the Nifty chart, so basically prior to that, if you checked, it was been trading in the range. So range on the downside was 15,600, 15,500 on downside, and whereas on the higher side 15,900, or precisely psychological level mark, you can say 16,000 was been acting as a resistance. And we were looking that now the stream has been over. There is no chance, there is no trigger that it can move up beyond that 16,000 mark. And as soon as it reaches to a level of 15,870 or 15,900 mark, we have seen a profit booking there from that level. No doubt the profit booking was hardly 200 or 300 points, but the trend still was been intact. That it has not given that trigger that it can break that level. The previous swing low, of Nifty was 15,450. So it has not given that level. It was moving above that level, so it has not broken that level. So that was a sign of a consolidation. Now, since we have moved about this level of say 16,000 mark, purely from a technical point of view, whenever this range has been broken and you add up that range on the higher side, so your target would be coming. So 16,440, 16,450 is an ideal target purely from a technical point of view. This is I would not be saying target also. I would be saying this is a resistance level where we might see a profit booking, or where market might halt and it can drift down. If 16,000 doesn't break, and if this another range of 16,000 to 16,400 band trades, then another leg of rally can be seen, and then another rally can be of another 300 or 400 points. So 16,440 and 16,700 are the level to watch as a resistance, or as a target, you can say, for a shorter term time frame. I'm using for what shorter term, that means 1 to 3 month time frame I'm looking about. Whereas support wise, downside 16,000 I would be watching, or precisely 15,450. This will be another level. And if this 15,450 breaks, then your short-term bullishness would be over. We might be coming to a bearish zone, and that level would be drifting to the level of 14,800 or 15,000. So right now, trend for Nifty is bullish. regarding with the banking index has been concerned. So if I talk about the banking index, so banking index, it was been same range was been there. The range was 33,200 on downside, followed by 34,300 on the higher side. As soon as the 33,400 breaks and it moved above, it was inching towards 36,200 or 36,000 mark. So now this 34,400 is a crucial level to watch. That should not be broken. If that breaks, then short-term trend from bullish, it would be converted into a bearish zone. Otherwise, 34,400 or 34,000 would be the level to watch as a downside range. Higher side 36,250, 36,300 would be the level as a resistance. If we are able to cross, the next level would be another 500 points. So I am looking banking index in a consolidation mode, but Nifty, it looked like there is another stream of say 150 points for very short term, and if, as I've said, 16,400 been crossed on a closing basis, or if we are trading for 16,450, then definitely we are heading for 16,700 mark.
Samir, if we talk about the mid cap and the small cap space, that has been in action from last 1.5 years now, and spectacular run that we have seen in both these mid cap and small cap stocks. Do they still offer value to investors at these current levels? I mean, if we talk about the top 100 stocks of NSE.
We're talking of the top 100 mid-cap stocks.
Yeah.
So some of them do still have some value, but largely, if you ask me, the percentage may be 2 or 3%, right? So the risk reward really is not that much again in favor. Like I keep saying one thing, you have to look at when you're studying fundamental analysis or when you're planning on doing long-term investing. If you buy a good company at a premium valuation, let's assume we get a correction, stocks come off, but eventually this good company will come back and go higher than it is. So 3 years down the line, your returns will still be there, positive, but they'll be closer to 12 or 13%. Whereas if you buy them at more fair or reasonable valuations, then your returns can be much higher at close to 18 or 19%. Now, when you compound that over a 3 to 5 year period, the differential in that return is quite significant, right? So if I just do on a simple basis, if I have a 6% for 5 years more, my returns are totally 30% higher. I'm not compounding it. 30% higher than what if I had bought it at a high valuation. So if you ask me, this is not the ideal time to do a lot of long-term investing because valuations are expensive. Yes, there are individual stocks where certain triggers have not played or certain things have not factored in, which will factor in going forward, and you're getting them at reasonable prices, be it large cap also or be it mid cap also, and that is where I think you have to figure it. So anyone who's looking to invest at this point of time needs to study 3-4 things. One is what valuation multiples it is on 1 or 2 year forward, why it is on this current valuation multiple, what has gone wrong for the company and what is going to change, and 3 are the return ratios, or is there something significantly advantageous to this company which is going to be sustainable over a longer term period. If you get 2 out of 3 also, it's worth taking a long term call. Ideally, in an ideal situation, we'd love 3 out of 3, but right now valuations are not in our favor, so we'll settle for the other 2 at least and hope for fairish valuations.
Now, since you have spoken about how to really pick up stocks for the long term portfolio, any of the stocks that you identify in the mid cap space that offer value, say around the current levels, or you would buy on any dip or any correction?
So there are stocks like that. So if you ask me, I think the banking and NBFC side has a lot of opportunity. If you look at the entire rally that's happened right now, this entire market rally, the banking and financial, it's been predominantly driven by your larger banks, right? You have your HDFCs, Kotaks, ICICI, Axis, and SBI that have run. Now, of course, there is a bit of stress in your portfolios for some of these mid-cap banks, be it an IndusInd Bank, an RBL Bank, an IDFC First Bank. Many of these are counters. But look, they're going through what ICICI Bank went through about 3 years ago when nobody wanted to touch them. Everyone is like, if HDFC can manage with a low NPA, ICICI is so high, or Axis Bank is so high, why should they trade at similar multiples, right? Now, I think we're getting that similar story playing out in the mid-cap banking pack. You have the valuation catch-up which has happened with the ICICI, Axis, and SBI. Not to the fullest extent, it can be a little more to HDFC. But I think if you look at in IDFC First Bank, Now, I don't deny they do have exposure to Vodafone Idea, but they do have some provisions against that as well.
Okay.
So even if Vodafone Idea does get impacted, yes, it would affect them to some extent, but it's 2% of their, or 2.5% of their overall book. It's not like the company is a dead duck, right? It's not like the bank is going to shut down just because Vodafone Idea shut down. They've changed the entire profile of that entity after the merger with Capital First, where they've become a retail focus. 65% of your loan book is retail. You're going to move to 80% over the next 2 to 3 years. You've increased your names. You have a lot of old problematic assets of the IDFC infrastructure business. You have certain infrastructure bonds which you're paying higher interest rates. All those things are going to change. So as that starts happening and the market starts realizing that, and the return on equity for someone like that, or similar story for an RBL, because they are also doing provisioning right now. All that gets done, I think there's a big catch-up going to happen in that. Similarly, with an NBFC space, where you look at a L&T Finance or M&M Financial, you have LIC Housing, L&T. So, there are many of these NBFCs in the mid-cap which still offer value, which have been beaten down because of certain stress, but that stress is all going to finish, and then you're going to see the next rally come in them, the way you saw it, I mentioned, in ICICI and Axis.
Brijesh, what's your take on the pharma space? Any of the counters that you like in the pharma space? Because there has been a bit of consolidation that we are seeing in pharma counters.
So if I compare, first of all, if I look out the pharma index, what I feel personally is that's nothing much promising. It's been in a consolidation mode. No doubt there are stock specific which can be look out for the investment point of view. But as a pharma index, it looked like right now at 14,570 it got closed today. Still, till it not been able to give a closing above 14,750 mark. I think there might be a drift down, and we might see a small drift of 200 to 500 points of correction can be seen. But individual stocks, if you ask me, then definitely I would be suggesting pharma, which look promising. Divi's lab, you can say you can go for investment still at this 4,900 marks. It look promising if your view is for a medium to or to a long-term horizon. Granule looks good. Cipla has given a bounce back from the recent swing low of 870 mark. Then Sun Pharma, that is surprising pack. The Sun Pharma was in a range of 660 to 710, and after the result came, it had broken out from that range, and it had made a new 52-week high and of 807. And if I'm not mistaken, today it got close somewhere around 785. So that looked promising. In overall, Sun Pharma, one can look for the investment for a short-term time frame at keeping a stop loss of 720, and it should be used to go long somewhere around 760 or 770. If it comes, then one can take a long position in it and play for the target of 880. And even if someone is looking for a 6-month plus horizon, then it has a chances of going in 4-digit also. 1,000 plus mark can be seen on Sun Pharma. So there are stocks which look promising: Granules, Sun Pharma, Cipla, and Divi's lab.
Samir, which are the sectors that you are overweight on right now? I know valuations have been a bit of concern for you because you have been talking about them, but sectors that you still like, and they are forward-looking sectors that you would prefer and suggest at this point in time, and the sectors you're underweight on that you would preferably stay away from them.
So I won't say overweight or underweight, but I'll give you a view on what sectors we think will be something that could outperform going forward. So one of them, which I very clearly mentioned, was the mid-cap banks and the NBFC space, which is where we have bullish positions. I still believe in the large cap pharma, there's a huge opportunity. So Sun Pharma, Lupin, Dr. Reddy's. And my reasoning for being bullish on that sector at this point is, if you look at the pharma market, which is the largest pharma market in the world, is the US market, right? The generics only comprise about 18% of the overall size of the pharma market. India is a large chunk of that, along with others, but India has a good size. But I think as that more and more drugs come off the patented list, the opportunity for the large pharma opens up a lot more because they spend a lot more on R&D. and they have a lot more products under their basket. With the consolidation which had happened in the US with the pharma distributors, buying from one individual player is a lot easier than buying from 20 small players, right? For these guys.
Right.
Now, Sun Pharma, Lupin, Dr. Reddy's have that basket of products and they can push their products across. That aside, Sun Pharma is also developing something like specialty drugs. It's not exactly generic, it's not exactly a patented product, but it's somewhere in semi in between. And that is beginning to scale up. So I think that space in the which is going to open up to the export market to the US still does have opportunity. I also believe there's a big change coming in the auto industry, and that's where I do have a bit of a bullish call. And that is from the point of anyone who has anything to do with electrification of vehicles. So something as small as a Greaves Cotton, who's doing the electric auto rickshaws and electric scooters. Yes, everyone's going to get into it. Hero's going to do it. TVS is going to do it. Bajaj is going to do it. It's a question of how fast you can set up your distribution network being a smaller player and how efficient your bike is. Now, these guys are scaling up. They've already got the bike ready. They've already selling. I think scaling up will be a little easier. Maybe they can do some sort of tie-up with any of these larger players and not directly sell, but give the the technology or the battery or whatever to some of these larger players also. So there's a lot of disruption there. Focus on that industry. You got to identify which are the stocks which could be the beneficiaries of that. Could a Maruti be a beneficiary, or could a Tata Motors be a beneficiary of the electric vehicle coming? Also, I like the fact in the so a Tata Motors or an Ashok Leyland from the fact that we still have a long way to go in replacing our trucks. Our trucks are very, very old, right? And with the scrapping policy somewhere near down the road, if that happens, you'll see a huge jump in the demand for the trucks and buses. And that will drive the demand for Ashok Leyland and Tata Motors in the domestic market. So that is one space also we think there is something you can focus on. I mean, infrastructure or something, those are sectors you can look at, power, but I think they're all fully paid up and they all have limited return on equity and return on capital, which is capped out. Your growth is based on how much equity you put in. IT sector, I do like from a long-term point of view, but I find valuations expensive. So I would say that's something I would look at, but on a significant, like TCS at maybe 2,800, I would be willing to buy, not at 3,300. Similar with Infosys, similar with TechM. So we are bullish on it, but I would say this is not the right time to get into the IT because I think the risk reward, again, valuation multiples are high. If there's one slip between the earnings expectation and the actual earnings, the stocks could come down quite. So you have to be a little cautious and stay away from that. So you could say that could be underweight, but yeah, I gave you 3-4 of them, which I think at the moment still throw out some opportunity for long-term investors.
Brijesh, if we talk about the metal sector, we are everybody's talking about a super cycle in commodities, and which is being reflected in the metal prices, which are ruling on a higher side fundamentally. Technically, which charts do you like the most in metal space?
So, as you have said, Gitu, regarding with the metal index, they are in a super bull cycle. Definitely, if you play with them, I would be going individually. First of all, there would be a leader, and that leader is no doubt Tata Steel. Now, Tata Steel, really has started from 300 odd level, and it has moved up to 1500 plus, and after that we have seen a small profit booking. But if you look at the chart, it has been making a higher top and higher bottom formation, which on a daily as well as on the weekly time, which indicates it's still in the bullish phase. So purely Tata Steel looks good. 1400 below if it comes, definitely one can look out to buy with keeping a stop loss of 1270, play for the target of 1620 to 1640 zone. Then sale look promising on a mild correction point of view, if I would be saying, because it was been trading in the range of 100 to 120 when the then range got broken. Now there's another 20 rupees range has been seen, from 120 to 142 range has been seen, and yesterday and a couple of days back we have seen that range breaking and it is moving up. So one can look out for buying sale at around present level of 141 or 142, with keeping a stop loss of 133 and play for the target of 155 to 158. And no doubt, nevertheless, we can look out to play with Hindalco. The rally had already started from 80 odd level and still has been moving up 400 plus. It's been quoting, so 440 it has been trading. So present rate or any dip of say of 10-15 rupees, if it comes, then one can look out to buy that stock with keeping a stop loss of 400 and 415 mark and play for the target of 460 to 470. But my point always here is that whenever you have been trading, always don't look out for the reward. Major point is the risk part. How much risk one can take. The reward definitely would be coming afterwards. So risk is that your stop loss. So always play with the stop loss. We always say, don't marry your stock. Always love your stock. Let the stop loss get triggered. No problem. Again, you would be getting a chance from the market.
Samir, if we talk about the IPO, there's a rush. There's a huge pipeline of IPOs. Are you comfortable with the kind of valuations at which these IPOs are being priced?
Short answer, no. Long answer, I think you see what's happened is everyone just loves the idea that you're getting something new to the market, unique story. Every story is being built in like there's, nobody is kind of doing this. Simply Krishna Diagnostics, which came for an IPO right now, massively oversubscribed. It's not like they're the only diagnostic company. Yeah, they're doing something a little bit different, which is they have a centralized head operations with, testing happening at various locations, but the doctor giving their final judgment from a Pune-based location. So again, valuations are expensive. So everything's coming in expensive. You have Zomato. It's a great story. I'm not denying the fact that I love businesses that are capital light, that have unlimited growth potential, because he doesn't need to put in any money to grow his business, right? But everything comes at a premium. So just to continue on the Zomato example, 4,000, it's trading at 1 lakh crore. If I want to even give it, say, because it's a tech company, asset light, even a 40 times earnings, he needs to be making a profit of 2,500 crores to justify 1 lakh crore market cap, right? That is going to take 3 years to come. So if I invest today, and in 3 years he reaches 2,000 crores odd, where's my upside over the 3-year period, right? I mean, then people are going to start looking, how far down the road do you keep looking? And what stops something else changing in this dynamic? Because you have no asset backing you. See, some trigger that changes something in the delivery industry or something could hurt you, right? So it's too far-fetched to go out and just believe that these stories are endlessly going to grow. I mean, IPOs are good. Some of these companies are good, but valuations are expensive.
Brijesh, FMCG counters have been lying low for quite some time, though they have performed quite well, if we see. But lately, they have been lying low. What is your take on the FMCG space? Do you like something in FMCG right now?
See, no doubt they have not participated in this rally right now when Nifty got corrected in a couple of months back, and still, nevertheless, we all know that whenever the monsoon season has been there, FMCG sector outplay on a positive way. Regarding with the FMCG sector, 2-3 stocks look good to me. No doubt we can look out for ITC. Obviously, it's a heavy weightage after the ICICI mark, and it's a good dividend stock also. But 215-16 mark, no, we would not be buying it. But if it comes around 200 mark, definitely one can look out to buy with the stop loss of 185 and pay for the target of 225 and 245. Then Dalal looks promising to me. It's been in a cyclic uptrend, and chances are that even it can move further upside. Then another counter would be Imami. If you look out on a chart point of view, it's been promising. 566 has been quoting, and to 525, 520 is a nice support. So any dip should be used to go long for the target of 605 to 610. This I'm talking for a very short term time frame. Marico is looking good. So there are few stocks which look promising. No doubt ITC would be the favor, but not at this level. Dip should be used to go long in it.
But you must add a disclaimer that if somebody holds an ITC, he needs to be patient with it.
Obviously, a lot of jokes have been circulated of the ITC, but I still prefer, see, nothing has been wrong from a chart point of view. It's gone on a long consolidation phase. And the best part is that we have seen a bounce back from 145, 165 odd level, and now it's been trading above the 200 mark. So, previously 200, 205 it was having a resistance. Still, it has been trading at this range, and it's showing an indication that another consolidation phase would be going. And after that, we can see a breakout of that what Nifty has been done. First couple of months it was been trading in the range, and we have seen breakout and it had moved up. So do ITC also look good. But while trading, as I have always said, play with the stop loss. 180, 85 is a nice support. So one keep that thing as a stop loss. But 215 to buy, I would be avoiding. Let it come to 200, 205 zone, then definitely risk reward ratio would be in your favor. Play for the target of 225, 245.
Hope for the best. Samir, one of the questions that comes to my mind is that we have seen capital raising activity in the market quite buoyant. But what about the credit cycle? What about the investment phase? Do you expect the companies to come forward now and start investing and adding to their capacities, which some of them have really announced, but on the ground, the action is really missing on that front?
So you're right, some of them have announced them. But a lot of these guys will only put money to work when they actually see the demand coming through, right? Now, just to give you the example of the cement industry, also something that we do like from a longer term point of view. And they also know that they're making good returns, but they know they're making the good returns because their prices are being kept high without the capacity being utilized fully, right? All these companies are running at 65, 70% utilization. At some point, something is going to break. Someone is going to say, look, I want to produce a little more. And down the road, that could be a problem. So they're not putting in money because even if I put in excessive money because I'm making great returns, I mean, companies in cement in a commodity making 24% ROE is unheard of globally. You're making that kind of money. Your interest borrowing cost for an Ultratech or for any of these larger players is 8-9%. So why not put in extra capacity if you can make that kind of ROE and just have to pay 9% interest cost? The reason they're not doing that is you're already sitting in an overcapacity zone. So a lot of people are announcing that they will put up new plants, but they're all going slow on it because the demand has really not come to that extent that warrants that it needs to be sped up. And, I need to get this capitalized so I can start producing it and make more profit off of it. It will happen. We're probably a year away from that. I think let COVID as a whole, right now, of course, there's fear of wave 3. Once all of these things get known, clarity is there. Once people realize that, look, COVID is going to be part of our lives and it's just going to be another flu if you're vaccinated, maybe then demand picks up and, you see a bit more of that. But I think at the moment, unless you're someone like a Reliance who's putting up a new business or green energy and that's the space where everyone is focusing, that you will put. But otherwise, a lot of the traditional older companies, even a steel company today is not going to look at putting up too much capacity right away because, look, you're making great money right now, but you don't know whether the prices are going to remain the same 6 months down the line. Because right now, China is doing something which nobody understands. I talk to these steel companies, and China, which was an exporter, has become an importer. How long before they again become an exporter, they also don't have an answer. Why they are importing also, they don't have an answer. Steel company managements don't have an answer. So to put in a lot of extra capital, again, take leverage onto the balance sheet may not be the right thing, even though they're making great profits right now. So it'll take time, but it'll happen.
But till that happens, do you expect the interest rate cycle to really, be this low, which we are, seeing at present? What did you make out of the policy statement by the RBI governor?
So RBI governor's statement, look, he's very focused on growth, right? So from the Raghuram Rajan times, it was all inflation driven, right? Policy was to be driven by inflation, data, expectations and numbers. Post-COVID, I don't think they are focusing at all on inflation. And I think that's something that's wrong because at the end of the day, if inflation rises very fast, which you can see, commodity prices and companies' profitabilities cannot rise if inflation is not there. There are two ways inflation goes up. One is you increase prices. Two is production increases so much and prices increase marginally that inflation is there, right? But right now, you're not getting that production increase. You're getting the price increase. And that price increase across the board is going to start hurting people's margin or you pass on costs. And as you pass on cost, the inflation going to keep getting larger and larger and larger. And then the RBI governor is going to have to play a catch up, and he's going to have to be aggressive. Now, free money is already there in the system. Loose money is there in the system. In India, you don't have free money, globally free money, but India, you have loose money system. That could change. So, could that affect your expansion plans? Your previous question, yes, it could. If interest rates start rising, ROE start coming down, again, that could affect. But how soon the RBI governor will, I don't think he is. I don't see him inclined to increase interest rates even if inflation is rising. Because honestly, if you ask me, the data, the way he's also seeing it is job creation is not there. A lot of this artificial growth is coming through in the numbers. SMEs are bleeding because of which large is growing. Slowly, as the trend reverses, maybe things will change. But at the moment, I don't see him being able, wanting, not being, he should increase interest rates at some point, but I don't see him doing it.
Rajesh, three stocks that I would like your view on is, one is Reliance, which is not going about 2200 levels. The other is L&T, which has performed well, but still a bit of momentum is being expected on this. So what's your view on the both stocks?
See, Reliance, if you look at the broader range of the Reliance is downside 1845 around, and on the higher side it has a resistance 2185 to 2200 mark. Now, if I look at today's chart only, it has make a bearish engulfing candlestick, so it indicates it can move further down. So immediate basis of resistance for to me is till it doesn't give a closing about 2150 mark, it has a chances of moving down. Now immediate support lies at around 2000 odd mark. So I feel overall trend wise it is flattish to bearish for the Reliance has been concerned, and till it doesn't trades above the 2150 mark, we might see further downside. And as I've said, 2010 mark is a level to watch for the Reliance. So better to be on a short side rather than be on a long side. I don't think from a short term point of view that Reliance can outperform. It has a resistance and can move further down. Now regarding with the L&T has been concerned, overall trend, if you ask me, it is on a bull side. Whereas the chart point of view right now, it had made a minor resistance at 1640 to 1650 band, but dip should be used to go long. So for me to buy L&T level would be somewhere around 1580 to 85 mark with the stop loss of 1555 and look for the target of 1645 to 1650. So dip should be used to go long on L&T, and right should be used to go short on Reliance.
Maybe your view, your advice for the first-time investors who are entering into stock markets.
So I think it's time to be cautious. Valuations are rich. Don't get carried away by a rising stock price. There's a saying that a rising tide raises all ships, but it's when the tide goes out, you know who's swimming naked, right? You don't want to be the one caught swimming naked. You want to be cautious with your investments, your money that you've made, hard-earned money. So be very careful. Buy low debt, buy growing companies, make sure valuations are fair. Far and difficult to find, but there are those opportunities that still exist. You just got to find them.
Rajesh, your advice for the first-timers who are entering into the markets.
So as what Samir has said, I'll add up with that. First of all, see, mostly whenever you are entering, don't run on anything, like right now, anything we look at, whether that be a technical point of view, whether that be from a fundamental point of view, all stocks have been running and they have already ran up. Now, suppose someone has want to invest right now, what Samir has said, I definitely would be adding. Look out to the debt-free company, look out for the sound fundamental company, look out for the large cap, the leaders. I would be saying look out to them. They are sound. Make a list of the stocks. These are good from a fundamental point of view, and regarding from a technical point of view, where your risk reward ratio is in your favor, whether you are a trader or investor, at least make the stop loss in percentage point of view, on a money point of view, anything which you feel. So make that thing and then approach to the market. Still, we are in the bull cycle and it is existing. Don't run. Be patient. Patience always rewards.
Thank you, Samir. Thank you, Brijesh, for your time. It was a pleasure speaking with you.
Thank you, Geeta.
Thank you, ma'am.